Hi, welcome back to capexforextrading.com. In this video, we're going to focus on the Relative Vigor Index, which is also referred to as the RVI. Now, we've set the periods to 10 here. However, we do use a period setting of 14. The reason why is because when we use other indicators in conjunction with the RVI, their period settings are set at 14. So it's always good that the indicators that you're using when you're using multiple ones all have the same period setting. But when we use the RVI on its own, we bring the setting down to 10. Now, as you can see, RVI is made up of two lines. One is green and one is red. Now, you don't need to know what these lines mean or how they're calculated. The only factors that we're concerned with are where do crossovers and cross-unders occur between those two lines, and what does that mean in relation to our price chart. So, in general terms, when the green line crosses under the red line, like it's done there, we usually have a downtrend. When the green line crosses over the red line, like it's done there, we usually have an uptrend. However, don't make the mistake of placing a sell every time the green line crosses under the red line, and don't place a buy every time the green line crosses over the red line. We need to look at the trading scenario in much more detail to ensure that the RVI is being used in the correct way. So the first way in which we can use the RVI indicator is by combining it with another one simply to confirm trend direction. And that indicator is a 100 period moving average. So if I just load that up to my chart, you can see basically when prices are below the EMA, we're looking to trade downwards, and when prices are above EMA, we're looking to trade upwards. Now, one thing you need to bear in mind with the RVI indicator is that we're not using the values in the vertical scale here. So we've got a lower value there and a higher value there. We're not actually concerned with the value that they actually represent. We're only concerned with these crossovers and what it means in relation to our chart. So when we're trading a downtrend, as well as looking for prices to be below the 100 EMA, and as well as looking for the green line to cross under the red line, we're also looking for new lower highs. And that's exactly what we've got there. But we're also looking for new lower lows, which is exactly what we've got here, 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 and here. So it is this printing of new lower highs that tells us that the trend is still going downwards. So what we need to do is get a horizontal line and simply reference every one of these lower highs to see if we can take the trade. So we'll start with this one, which is lower than this one here. So can we take that trade? No, because the green line has not crossed over the red line in the RVI. So we move on to the next one. So we move that across here. No, the RVI is still not crossed over. Now, we're not going to use this one because, as you can see, this high is higher than this one. So that doesn't comply with our rules. So we move on to this one. It's lower high. Yep, the lines have crossed over. However, we can't take that trade because this low is higher than this low. Remember, it needs to be lower. This low needs to be lower than this one, but it's not. So we move on to the next lower high. Move it across. We go, yeah, lower high. We also got a lower low, so this looks good. This low here is lower than this one, and the lines have crossed over. So this is the low, sorry, this is the high where we would take the trade. So if I just move that across, our profit target is just a few pips above the previous swing low, which is here. So that's our profit target. And our stop loss is just a few pips above the last previous high, which is here. So that'll be here. Our trade would be here. So this is our risk area in between these two lines. And our profit target is all the way down here. And look how quickly the market dropped when we took that trade. Okay, so everyone's doing the same thing. The market is showing signs of continuing to go in a downwards direction with these lower highs and lower lows. We're trading below the 100 EMA, and our RVI has crossed over. The same applies when we're trading in an uptrend. So the rules are the same, except they're in reverse. So what we're looking for now are prices to be above the 100 EMA, but we're also looking for new higher lows, which is what we get here, and new higher highs, which is what we get here. So we've got a perfect uptrend there. So as long as we have a crossover of the green line over the red line, we can take the trade. So let's look at this swing low here. So this low is higher than this low. Great. We also have a previous higher high compared to this one. So that's our profit target. So our profit target would be here, our stop loss for this low would be just a few pips below the previous low, which is there, so that would be here. So our trade would begin at this point here. So this is our risk in between those two lines, and this is our reward, basically up until the last previous high. So you can see that the same rule applies as long as the crossover is happening in RVI, but the rules are in reverse in terms of our highs. Remember, when we're trading down, we're looking for lower highs, and when we're trading upwards, we're looking for higher lows. So the last way in which we can use the RVI is by referencing this zero value that you can see here. Now, we're not using the value because of its characteristics. The only reason why we're using it is because it's our center point. So what we do is draw a horizontal line and make sure that the value is set as 0, press OK, and we double click to ensure that the line doesn't move. So basically in this method, what we're looking for is for the RVI to be at the right side or on the right side of the zero line. So when we're trading upwards, we need the RVI to be above the zero line. And when we're trading downwards, we need the RVI to be below the zero line. And realistically, that is as complicated as this method gets. But remember, the same rule applies with the lower highs in a downtrend and the higher lows in the uptrend. The only difference is that you have to now wait that for the RVI to be on the right side of the 0/center line. Now, what you might find is that if you only use one of these methods, you may get into trends a little bit late. But if you combine both of those methods along with any other indicators that you find comfortable working with, you may see or you may find that you're not going to miss out on any trading opportunities. So experiment with other indicators that you have. Otherwise, combine the two methods that we've shown you in this video and you should be okay. So if you have any questions or comments, we'd love to hear from you. Just put them in the box below. If you haven't done so already, please subscribe to our YouTube channel or follow us on Facebook, Twitter, LinkedIn or Google+. And we shall see you for the next video.